Good evening, everyone. Thanks for coming to our webinar on our Forex system. And just a little bit about myself. My name is Mark Sachs, and I was a graduate of the University of Pennsylvania, here with Right Line Trading, and also IT Group. I'm a former professor at Jefferson University in Philadelphia, PA. And I've been involved in the financial markets for over 20 years. And I began trading the futures and Forex markets about 10 years ago. I was involved in the optimization of software systems for the last 10 years via mathematical modeling. And I got into that when I did my thesis on the optimization of underwater decompression schedules. And that was back when I was in college and graduate school. And what we did at that time was a novel approach to a complex problem, was create a multivariable equation out of underwater decompression dives. When you come up from the bottom of a really deep dive, you have to undergo decompression, and you have to stop on the way up to switch oxygen mixtures, and it's a very difficult task. And the decompression schedule very complex. And used to be done by trial and error by the Navy. So what the Navy did was develop ASOP, which is the Automated Engineering and Scientific Optimization Program, which is a program for determining and optimizing multivariable equations. And via its use, I was able to optimize underwater decompression or coming up from a deep dive. When I got involved in the financial markets, I looked at at the movement of price as nothing more than the final end result of some multivariable equation which determined future price movement. And that what was needed to do was determine what the independent variables are that go into the equation and provide you with a very accurate and precise value for future price movement. So that's essentially what we did here at Right Line Trading, and that is to create the modeling, create the multivariable equation, and then optimize it. And the end result is the software that we trade. You'll see that the methodology that we use is very different from that of almost everybody else. Now, I just want you to see quickly that one of the reasons why 95% of all day traders fail is because they use information that has been given to them but has never been proven via rigorous mathematical testing to have any significant predictive value in determining future price movement. And also that some of the indicators, when combined with certain formations, just don't work. And if we look at a stochastic oscillator and Renko bars, what we see is that the equation for an oscillator requires 4 values. And that's the open, the close, and the high of the low of every formation. And the formation can be a candlestick, an open, high, low, close, can be a modified Renko, but you need to have those 4 numbers to plug into the equation. And if you look at Renko, this is just a traditional candlestick. This is an 8 range, and this percent K line is an accurate line. But if you look at Renko, there's no open close. There's only a high and a low. And I've seen many, many software packages buying Renko with stochastic. And this percent K line doesn't work. It's simply tracing out price. It's not really giving you an overbought, oversold signal. And this is something that you have to be very, very careful about. You have to actually take a look at the indicators that are presented to you in any given software package and make sure that they actually work. Because believe it or not, some of them don't with charts like Renko charts. Now, how do you trade a stochastic? Some people, and the problem is that people trade the stochastic in two different ways. Some traders believe that when a stochastic is overbought, and it can be any stochastic, it can be any oscillator. It can be the stochastic, relative strength, the CCI, the percent K, Williams percent K. When the market is overbought, they believe that the bulls are firmly in control. And what they do is continue to buy each pivot as the market breaks it to the upside. That's one way of using the oscillator. Another group of traders look for the oscillator to look for oscillator divergence and look to take a reversal. When stochastic, well, in this case, relative strength makes a lower high and price makes a higher high, there's divergence. And what they would do is take the oscillator signal as a method to go short and to fade the market. Now, if we look at two groups of traders trading the same indicator in different ways, you have to do an analysis of the oscillator to determine which group is right. And what we did at Rightline is we looked at 2 years of market replay data to determine which group is right. Should you trade the stochastic by simply buying the market in an overbought or oversold condition, or selling in an oversold, or should you look for oscillator divergence? And the answer is that neither signal provides you with adequate precision or predictive value to give you any data useful enough to base a trade on. So essentially, we have proven that an oscillator doesn't really have any role in predicting future price movement. Now, eventually, you're going to see that there's a common thread for all of these indicators. But if you look at the sensitivity, specificity, and positive predictive value, or the ability of this indicator to determine future price movement, it is so low that it cannot provide you with a signal that increases the precision by which you trade. Its input doesn't help you get a winning entry. We also looked at Fibonacci. Now, Fibonacci was a mathematician that lived, I believe, in the 17th century. And what he developed were a series of Fibonacci transformations. And from these transformations came Fibonacci numbers, and then Fibonacci retracements and Fibonacci extensions. And if we look in nature, we find that Fibonacci really doesn't have very much usefulness. It predicts the number of edges on a snowflake, and it predicts the number of ridges on a pine cone, but it doesn't really predict any major interaction between two bodies in a closed system, like many of the major really complex equations that we look at in quantum mechanics. that describe how two bodies interact with each other on a microscopic level. So there was really very little utility in the whole Fibonacci process. Now, when Fibonacci created these extensions, there was no such thing as the stock market. And then some bright guy had the idea of applying them to price movement in the market. Now, for the life of me, I have no idea why anyone made that the teleological assumption that Fibonacci extensions and retracements would somehow predict movement in price on a financial instrument. I mean, to me, it doesn't make any sense. And again, this is why generation after generation of day trader continue to fail at a 95% rate. It's because each generation continues to accept concepts like Fibonacci as being true without ever being shown to be true via rigorous mathematical testing. So what we did was do the same thing. We looked at 2 years of market replay data and the precision with which Fibonacci extensions and Fibonacci retracements actually predict future price movement. How often does a Fibonacci level hold? How often does it break? How often does price respect Fibonacci levels? And what again that we found was that the predictive value of Fibonacci is so low that it really doesn't have any usefulness in determining the future movement of price. So what we did was eliminate two very, very common indicators that are used by a vast number of traders to try to help them determine an optimal price entry, and found that they really don't have any usefulness. So we were creating a new paradigm, a new way of trading. And what we were doing was not accepting anything that we were told by other traders or read in books to be true unless we could prove it ourselves independently and verify that this was the case. Before I get to the slide, what I wanted to do was say that we just recently tested the MACD. Now, MACD is a very, very popular indicator. People use it all the time. It consists of two moving averages, a signal line, and a MACD line. And when the fast moving average crosses the slower moving average, you get a MACD crossover. And supposedly that's supposed to predict movement of price to the upside. MACD crossover to the downside would predict movement of price to the downside. What we found again was that the MACD, in providing you with information useful enough to accurately predict future price movement, was just not there. And that the MACD as well was not useful in determining future price movement. So that's really coming up with a lot of information that really goes against what's generally accepted as being accurate. But again, this acceptance is just based on what's called anecdotal data. It's based on what you were told. It's based on a story some guru told you. But if you look in the world literature, that you will find no scientific analysis of that indicator to prove that it works on a mathematical level. So ultimately, what's the predictive value of any indicator that uses data from only your trading chart? And what is the predictive value of any indicator that works sometimes but not other times? And essentially, if the data that the indicator is using is the information off of your trading chart, it renders that indicator useless. Now, in the case of the oscillator and the MACD and Fibonacci, it doesn't make any difference what time frame you're looking at. But the predictive value of an indicator that assimilates data from your trading chart will never be able to look into the future. It's never going to be able to tell you where price is going to go into the future. Now, there are only 5 parameters that are present on a trading chart. And software developers have created all kinds of quote, sophisticated indicators to, I just saw one recently. It was called, I'm going to forget the name of it, but it looked at when institutions come in and start moving up price around based on when they did it going into the past. But there's only 4 parameters you can use, and they are 5 parameters. They are the open, high, low, close of a formation and volume. There are no other parameters. So all indicators are only based on one or all of those parameters. There's no other permutation or no other way to create an indicator. So a lot of these fancy new indicators and fancy new names are really just different ways of expressing the evaluation of one or all of those numbers. So the predictive value of any indicator that works sometimes but not another is essentially for day trader, swing trader purposes 0. If it doesn't have enough precision to increase the accuracy of your trading entries, then it has no predictive value. And what you want to be able to do is predict future price movement. And that's really, I'm basically giving you the nuts and bolts of why 90%, 95% of day traders fail. And what you have to ask yourself, and this is really of extreme importance, is why is day trading an endeavor in which 95 out of 100 people who begin it fail, and that number never improves? Why isn't it such that when 10 generations back of day traders, 95% failed, why didn't the next generation learn from the previous? And why, as we move forward in time, does the win percentage of overall win percentage of day traders improve? Why doesn't it ultimately not drop to 50-50, where you assume that we can't beat any institutional trader and we're up against the other commercial traders, the small traders? Why can't 50% of the small traders beat 50% of the other small traders? That number should start getting better and better as we learn more information about how to day trade and improve the accuracy of our trading entries and improve our trading methodology. But what I found looking back is that the way we day trade today is the same way we day traded 20 years ago. We use the same indicators, overall basic same trading methodology, based on the same concepts that have caused thousands or tens of thousands of day traders to go broke. And we don't question the validity of any of this. Nobody asks themselves, is there really something better? And they walk off that same cliff. This is what we do not want you to do. So what we did was we looked for indicators to create that actually provided you with outstanding predictive value. They were going to tell you which way future price movement was going to go. And the first indicator that we created is called the bias indicator. Now what the bias indicator does, and we use it on the Forex very, very successfully, and we use it on the futures market very successfully as well, and it's also useful for stocks, is that when the background here on your chart is pink, and I'm going to show this to you later, It means that the two higher time frames that this indicator assesses are moving to the downside. So you have downside alignment of the two higher time frames. And it means that all support to the downside is broken. So the higher time frames are moving to the downside, and there's no support left to break. So price on your trading chart is very likely to move to the downside as well. Now, price on this slide, as you see it on this chart, doesn't turn the background pink. The background pink, the color, is created by the analysis of higher time frames. Price moves down because of the pink background. Now you've created a clear-cut direction for price. And by doing that, you've increased the precision by which you trade, because you know that with this kind of background, the only trades you're going to take is a short trade. So this does accurately help predict future price movement. And as long as this color is present, we know that any retracement is likely to turn back over to the downside. So move up, a roll over to the downside. A move up, and a roll over to the downside. So what ultimately you'll see we look to do is look for the move up, trade the rollover. Look for the move up, trade the rollover, because we know that price is strolling to the downside on two time frames. That's a real trend when we get this long-term time frame alignment. And the duration of the longer-term time frames depends on the duration of your trading chart. If you're trading a 5-minute chart, one longer time frame is 15 minutes, and the second longer time frame is 45 minutes, each times 3. Now what we also did was, first I want you to again remember that none of these indicators are using price on your trading chart to generate any information. They're using price on either higher time frames, and in this case, this indicator is using price and the direction of price from other markets. Now we know that if you look, the market essentially, or financial instruments, are essentially the end result of money rotation or money flow. The institutional guys will simply rotate essentially a fixed amount of money around different financial instruments as different scenarios play out in the course of the day. Like one of the things that we trade is crude inventory for the futures. On the Forex, we look at the change of interest rates on different currencies. Now, these are things that are going to change traders' perception of the value of an instrument and are going to create price differences. Now, what the quant lines do, each line evaluates the direction of markets that correlate with, in this case, bonds, but you'll see later that it could be any Forex pair, and determine the direction of that price. So let's say, for instance, that we're looking at, I'll give you the example for bonds, but like I said, it could easily be any Forex pair, and the analogy directly holds. Let's say that institutional traders perceive that there's significant risk in trading stocks. Something comes out that a lot of companies are losing money. There's a change in interest rates in the United States. There's going to be quantitative easing in a specific country. All of these things affect the value of stocks. Now, if traders are going to pour their money into stocks, then it's likely that bonds and treasury notes are going to go down along with certain Forex pairs. But if traders don't want to trade stocks, let's say that there's a lack of quantitative easing, or there's a major negative occurrence, there's a terrorist attack, or a major storm, there's a disruption to the crude supply. But something changes. Correlative markets are the markets that move either in the same direction as bonds or in the opposite direction of bonds, with a 70% correlation coefficient, where the correlation coefficient is 0.7. Now, when both quant lines are green, and you're going to see the futures quant lines as well, because I'm going to show you the workspace, it means that money is flowing into bonds. And you can see when both lines are green and the institutional traders are moving money into correlative markets that go up when bonds go up and taking it out of markets that go down when bonds are up, you know that money is flowing into the bond market. And that's why price goes up. The lines don't turn green because price goes up. Price goes up because the lines are green. And what the lines are looking at, the direction of movement of correlative markets. Now, each individual market has its own set of correlative markets. So we have to create a quant line for each individual market. Now, the other indicator that definitely increases the precision of your trading and increases the accuracy of your entries is market profile. And I'm sure that a lot of you out there are already very familiar with this indicator. And it's really price, volume at price. Now, this is the point of control, and this is where most volume trades on a given instrument, whether it be Forex or futures. So traders like to set the price, in this particular case, of crude oil at $37.60. And essentially, around the point of control is a bell-shaped curve that comprises 67 2/3% of all volume that's crossed on this instrument. And this is what we call the fair value for the price, fair value for the instrument. And this is where price really wants to stay. It wants to stay where 67 2/3% of all volume crossed. Now, when price breaks the value area high and then retests it, it breaks fair price and is now overpriced, essentially. But it's moving out of the bell-shaped curve and further off into the wing of the bell shape. It breaks resistance and comes back and retests resistance. You then take a trade to the upside. And the same thing happens to the downside. If it breaks support to the downside, you can take a trade to the downside. Same thing happens to the point of control. The market comes and tests it, retests it, and on the retest, you can take the market short. So these areas of support and resistance, this is the value area high, this is the value area low, and that's the point of control. Greatest volume at price, and 67% of 2 2/3 of all volume at price, encompassed for the value area high, the value area low. Now, market profile is extremely important in determining the precision of your trading. You can use it to trade off of, and you do not want to trade into it because it's a strong area of support or resistance. Now, each market profile line are not equivalent. Remember, if the determination of market profile is just based on the prices on your trading chart, remember our theme. price on your chart does not give you, the assessment of price on your trading chart does not give you enough information to increase the precision of your trading. So what you have to do with market profile is you have to do a look back. And you have to look back a certain number of days. And in order to determine optimally what those number of days are is you have to do a lot of testing. What you want to do is optimize the number of days. And the way to do that is if the number of days that you look back are too small, market profile gets buffeted around by any major change in price. You'll see that the point of control moves a lot. The value area high, value area low move a lot. It becomes an indicator subject to whipsaw. And you want the indicator to have stability. So that anchor is created by the price movement of additional days. But if you look back too far, then market profile becomes stuck. And it goes from being whippy to being sort of difficult to move. And if it's difficult to move, then it no longer accurately reflects true areas of support and resistance and encompass that 67 2/3% volume. So the proprietary look-back day number is really key, and you're going to find that each market profile indicator almost always just assesses price on your trading chart or allows you to create multiple different market profiles, one that looks back a day, one that looks back a week, one that looks back a month. But we found that to be too complex and too difficult. So all we have is one market profile indicator which does a look back a certain number of proprietary days and provides you with really, really accurate areas of support and resistance. In addition, we want to get a market profile that does an intra-candle calculation. Because if it only does a calculation at the close of a candle, there's a chance that you're in the trade and you're looking for a close to the upside. So you're going to buy a close to the upside. You're going to see what that means in a minute. As soon as you enter the trade and the next candle forms, market profile can jump right in front of your trade and really create what was a great trade into what becomes a really disastrous trade. And it can cost you the trade. That's why you have to have a market profile that, one, does a look back on a proprietary number of days, and two, does its calculation intra-candle. And as far as I know, we have the only market profile that does that. All the others do not. They either look back one day and ask you to do a 5-day, a 1 month, and you have to have different histograms on your chart, or they calculate market profile lines at candle close. Both of those are not good features. Now, the other thing that we want to define is the trend. Because the prevalence of taking a successful trade is always greatest when the market is trending versus when the market is choppy. So we created a proprietary 15-period moving average. When it's yellow here, you can see we made it so that it remains stable. It takes a significant amount of price movement to budget, because we want to trade with a lot of specificity. And when the 15 and the 50 are red and price is moving to the downside, we look and you're going to see how our charts actually assimilate price action. This is market structure and this is price action. And what makes that so important is this. And what I'm trying to do is give you all the independent variables that go into the multivariable equation that we've optimized to produce a software platform that really gives you a tremendous ability to look into the future and determine price movement. Now, during periods of consolidation, a lot of people look at this as a drop in volatility and believe that as consolidation continues and volatility remains low, volatility is going to explode out. Now, that may be true, but we look at this in a little bit of a different way. All the traders in this candle, the majority are short. All the majority of traders in this candle are long. Short, long, short. So what you do is you have 1, 2, 3, you have 5 groups of traders. 3 are in this trade to the short side. Now they're counter trend trading. They're trading against the trend. And these 2 groups of traders are trading with the trend. Now, what makes consolidation so powerful is that when it breaks out of consolidation, it almost always breaks out in the direction of the trend. It's going to be pushed down by 2 forces. One is it's going to be pushed down by the addition of new sellers, and 2, by all the traders caught in these counter trend candles being stopped out. So as all these traders get stopped out, it helps to push the trade to the downside. When they're stopped out, they sell their contracts in order to unload them. And so the move shoots down with a tremendous amount of power. Now you're going to see that our software does an assessment of the trend and gives you a signal out of consolidation. So the goal of right line trading is to provide a multi-time frame market structure analysis, a multi-time frame indicator analysis, only on those indicators that really have predictive value in determining future price, and create a simple trading platform that's been optimized mathematically to provide you with really accurate trading entries. And you're going to see just how accurate they are. Now, as part of our algorithm, this is a little bit of an old slide, but essentially our core methodology is that we don't trade potential tops or bottoms and do not trade reversals. We do not counter trend trade, and we do not trade potential breakouts. We take retracements into a multi-time frame confirmed trend with multi-time frame market structure and alignment. And you remember if I showed you that background bias, every time the market moved up into that pink background, we would take a confirmed rollover back down in a confirmed downtrend. Those are the bread and butter trades of right line trading. We have since looked at some very, very powerful reversal patterns, but we do not trade them on the Forex markets. The only thing we do on the Forex markets are we trend trade. And we look, again, for multi-time frame confirmed trend with multi-time frame confirmed market structure and alignment. We look for all of the independent variables to align that we know are important in giving us a successful trade. We know increase the precision by which we trade. Know they increase the positive predictive value of the trade that we take. We wait for those signals. Now, just to give you an example before we turn to the platform, here's a trade out of consolidation. Here's the signal. It goes down for 8 ticks. Here's a trade on a falling channel, 18 ticks. Here's a trend trade for 3, and then one for 17 ticks. And you can see the quant lines or correlative markets are almost all red. Background bias is red. We have an alignment of all the higher time frames moving to the downside. Now the candles outlined in order in red, that tells us that two other independent variables, order flow and momentum, are also aligned to the downside. 19 ticks on a move down. Remember, we get a retracement, which is a move to the upside, and we look for the rollover. On the rollover, this candle takes us 19 ticks. Same thing, the move up, we look for a retracement, a rollback. In an uptrend, all the quant lines are green, background bias is blue. Up we go for 3.75 points on the E-mini. So let's take a look now at our trading platform. Now, these are all Forex markets. And here's how simple we've made it to trade the Forex. And it's remarkably effective. IT Group has been using it and have gotten tremendous results. IT Group is our partner in our Forex trading. We're going to be opening a Forex trading room on August 1st. We both use the same software, and they've been just getting outstanding results. We're going to join them live trading on August 1st. And then let's add this is our Ninja Dome Trader trade execution platform. Now, before I tell you how this works, I want to show it to you. What I'm going to do is I'm going to move a video that I made onto the screen. Now, because the markets are closed, it limits to some extent what I can show you. And I want to show you how the dashboard, well, first let me just tell you quickly about the dashboard. The dashboard is to the left of each market. You'll notice that I have the markets closed. Now, we're looking at 9 Forex pairs here. And as long as the independent variables that we look at are not in alignment, we know there is no trading opportunity. There's no reason to look at the chart. What we've done is we've programmed all the independent variables into the dashboard. This is an algorithmic system that's been programmed into the dashboard. Now, when background bias is aligned, let's say to the downside, the quant lines are aligned to the downside. The modified 15 is moving to the downside. And a bunch of other independent variables all aligned. You're going to get a trading alert. And what you're going to get a flashing orange light. And if you want, you can also have it beep. So it's definitely a visual, and it can also be it's definitely an audible alert and a visual alert, and you can add the audible component. As soon as you do, you open the chart, and what you're going to see, I just have to reboot it. That's okay. Since we don't have a live market, it doesn't matter. I'm just waiting for it to reload. It's moving slowly, but it will reload. Now here's all the colors we look for. Now, when all of the independent variables align, you're going to get the alert. And when you get the alert, you open the chart. Now, if you look at the chart, if you get a green dot while an alert is flashing, right here, let's find where you would get an alert. So right here, if the quant line red, background bias red, you're going to get this dot intra-candle. The alert's going to come before the candle's formed. You're going to have plenty of time to put in an order to take a short trade on this trade to the downside, one tick below the close of this candle, and you simply do that by hitting our NTD and hit sell on a down close. That's all you have to do. It will track the down close for you and give you an exact entry one tick below. And then our ATM takes over, and the entire trade is done automatically. And this particular trade would have given you nine pips. And this trade to the downside is stopped right by the support of the value area low, breaks the pivot, and comes to rest on support. There's a dashboard entry. You're going to get an alert well before, when you open the chart, you're going to see the dot, but the candle will be just forming to the downside, and you're going to hit that sell on a down close button. You're going to be in. You're going to see that you're not going to have a problem with having time to take the entry. Let's find another really nice trade in which you're going to get right here. Green quant line down here. Candles outlined in order flow and momentum. Confirmed uptrend. Dark green color. You get two dots. This is two system-generated signals on the same candle. Now, if you have two dots, the entry is even more powerful. Don't wait for two dots. Just trade one dot. But what the two dots tell you is that via two separate algorithms, this trade has been determined to have a very, very high winning percentage. And each algorithm assesses slightly different independent variables. So you're going to put in a buy and up close right here, and you're just going to hit buy on up close. The trade's going to hit, close to the upside, and what you're going to get is a move to the upside of 10 pips. Now, an alignment like this doesn't take place that often because you need a lot of independent variables to align in order for you to get that kind of trade. And this is why you can watch multiple markets. And what we call it is cherry picking your trades. You're only going to take those trades that have an alert. That tells you all the independent variables are aligned. Now, maybe that alert won't come with a dot. A simply green dot, go long, red dot, go short system is never going to be enough. That's why this really has an algorithmic alert to tell you when an entry, a system-generated entry, is going to have the kind of predictive value you want that's going to give you consistent winners. And this will provide you with winners at an 85% or greater rate. 85 out of 100% of the trades that you take with this system are going to be profitable. Now, I'm going to show you a trade here taken live. Now, I'm going to I'm going to turn off the volume, and I'm going to sort of moderate. Now this is the USD cross Japanese yen, the dollar yen cross, and you can watch the dashboard. Now I'm talking in the video, but I'd rather talk to you without having the volume in the video. Now the market's moving very slow, so what I'm going to do is I'm going to move it forward a little bit. Now, if you watch the dashboard, you see it's also assessing volume. You see that's the number of contracts. Now, there's the alert. Now, let me hold it here. Now, if you look, it's dark, but you can see you have the orange alert. The quant line is red. The modified 15 is red. Background bias is pink. And really there's a multitude of additional variables, including an assessment of contracts crossing per minute, volume, that go into the trade to create this alert. Now you open the chart, and all you do is look for a red dot to appear. Obviously, you're going to be taking a short trade. We have no dot yet. You're waiting for one, and the alert's still flashing. And there's the dot, right there. As soon as you see that, you're going to hit sell on a down close. Let me close this trade. The reason it's not closing is because the market's so slow. It has to make one tick in order to actually close the trade, and the market is moving incredibly slow. But you're going to hit right here, sell on a down close. And you're going to be in one tick below the close of the entry candle. You can see volume is moving a little bit slow. Now you're in the trade. And you see the NDT stamp? It tells you that the market that the NDT has executed the trade to the downside, and it shows you the exact tick level that it's done it at, one tick below the close of the candle. The candle flips around. And the entry is actually getting a little bit of heat, but it's far from stopping out. And that's the trade evolving. And you can see it right here. So now the alert is gone, and if you got another red dot, you would not take the trade. With no alert, a short dot is ignored. And the first up close takes you out of the trade because we close on an up close. That's just our ATM. But this gets you in, and I'm scaling the trade here to see how many pips we get. And we get 13 pips. So that's the system. And what this allows us to do is to look at multiple markets. One of the difficulties we always have as traders is finding a great trade on an individual market. Sometimes markets spend an enormous amount of time in chop. And we waste our time looking at them. So why don't we wait to even look at a market until the independent variables that we know are important in taking a successful short trade or that we know are successful in taking a successful short trade actually align and provide us with a potential entry. This is the Euro USD. I know it's a popular Forex market. And unfortunately, I'm going to have to reload this too. We're going to have to wait a minute. Because on fractal indicators, remember, our indicators analyze data from multiple time frames. We have to reload because that's the way Ninja Script works. Now we're going to find a really nice entry. In retrospect, it's simple. That we could have taken with an alert. And I just want to go to a trade where I know everything is aligned just because I know the system. Now, we're not going to trade into support or resistance. And this dashboard is going to help us. And here's the trade right here. Everything is aligned. This color is acceptable as well as the pink. This is going to be your entry. That's going to be your entry right here. Oops, excuse me. I'm hitting the wrong here. You're going to be in one tick below. That's going to be taken with the dashboard humming away, giving you the alert. And you're in. And the trade is going to go all the way down to here. Now, if you get a dot without an alert, you don't take it. If there's an alert without a dot, you have no trade. You have to have complete alignment of both all the independent variables that have been programmed into the dashboard, our algorithmic entry system, align with an algorithmic system that determines when a short trade should be taken and exactly what candle it should be taken on. When you get the alignment of the two, you've got yourself a terrific short trade. And these trades usually run. Now, all we want is a first target, depending on the time frame that you're trading. It works on any time frame, any kind of candle. I like range, but you can use a time, you can use a tick, you can use a modified Renko. Trade with anything you like. I think IT Group uses a 1 minute and a 5 minute. It is irrelevant. The same principle is still operational. You wait for the alert, you open the chart, and then you wait for a dot. There are going to be times when an alert appears, but you just don't get a dot. And if you just watch the chart, there are going to be dots that occur without an alert, and those are not tradable dots. So this dot is oversold, and you won't get an alert because this dashboard monitors the overbought, oversold conditions of the market and will stand down on an oversold signal and not alert you. It's very smart and has programmed into it so many independent variables. You don't get many perfect short or long signals. But if you watch multiple currency pairs, you're going to get a really good number of trades on a given trading session. So let me take a look and see if there are any questions, because really that's the nuts and bolts of the system. It's not whether you have a dot, it's whether you have a dot and an alert. And this is a dot, it looks like, going right into resistance to the upside, and so it will be a trade that you don't take, and you will not get an alert. It's going to have you avoid taking a huge number of losers that or traders very commonly take. Now, because of its specificity, there are going to be some good trades that it just doesn't line up on. The market is going to roll, and you're going to get, here's another one right here. Quant line's just red. Look at that trade to the downside. 16 pips. Now, I don't know how many pips you're looking for in a day. It may be based on the number of lots you're trading, but you can make a lot of money off a 116 pip move. Now, that's the full move. You know, we all talk about entry to the low of the move or the entry to the high of the move. We're never going to take the trade out at the very low, at the very bottom. But we're going to take the trade out on a reversal candle, and that's still going to be a very, very nice trade. Now, if you do it based on our ATM, this trade would give you 11 pips. It's going to take 5 back on the reversal candle. And, you know, that's what you bank, and that's a great trade. You can take the trade off at a given target if you want. If you're looking for 10, you're out at 10. If you're looking for 12, you're out at 12. The ATM, we give you a recommended ATM, but ultimately it's up to you. And this is what IT Group is using, and they're using it tremendously successfully. We're joining them, I believe it's Monday. And we're going to have the live trading session, and I believe it's 7:30 in the morning. Now, here's another one right here. Now, on this dot, there's no alert because this background color is not acceptable to the dashboard's algorithmic system. And if you took this trade, you would have been stopped out. But because the algorithm is so powerful, here's your entry and here's your win. Gets you to sidestep this loser and hands you this winner. Now let me see if there are any questions. Now I just want to say that if you haven't gotten an email regarding this, the first week in the room is free. It's a free introductory week. So you don't have to worry about money. The trading room on a monthly basis, the cost of the software if you want to purchase it, which includes the dashboard, includes the software, it includes the NDT, everything you need to trade. We'll provide you with all that information. But for Monday to come into the trading room at 7:30 a.m. and watch us trade the dashboard and all of these Forex pairs is absolutely free, and you get to watch us for the entire week. So if you aren't sure of its power and you want to see how to trade it, just come on in. I mean, if you trade other markets, that's 7:30. I don't know how long we're going to be going. Monday's going to be our first day, and we're coordinating this again with IT Group. They are superlative traders of the Forex with an enormous amount of experience trading the Forex. We'll see how to get that dance down perfect on Monday, and then we're going to be off and running for the rest of the week, and you watch the system and see how much money you're going to make. So let me see if there are any questions. Okay, very, very few. We'll update it, Ron. Kurt, what we do is this. That's a really good question. If you want to trade, if you want to trade a different time frame, what we do is we create a template for you, because there's so many indicators on the trading chart itself that are algorithmic in nature and require multiple inputs. We'll just make them for you. We have a library of time frames on different charts. We probably have 400 or 500 templates. So let's say you want to trade minute bars. We have a 1 minute template for you. All you have to do is insert it, and you're good to go. You don't have to make any changes. If you want us to show you how to create your own template, all you got to do is call us, and we can show you. But if you just want us to create them for you, 99 out of 100, we're going to have it already. We've been asked for daily bars, 4-hour bars, 8-hour bars. I mean, I can't even go into it. 5 range, 3 range, 13 range, 21 range, 35 range, and really, 1 minute, 2 minute, 3 minute, 5 minute, all different types of time. So we can just email you the template, and you don't have to make it. You don't have to make any change. I'm going to have Rory put the link into the room for the sign up on Monday. Hang on 1 second. Hang on 1 sec. I'm sorry. What Rory did, since we get your email when you sign in, we've registered everybody in the room for Monday. So all you have to do is come into the room. And hold on. And what you're going to do is you're going to get an email on Monday morning about 5 a.m. GoToWebinar sends that out. And the GoToWebinar is going to have everything. It's going to tell you the start time. It's going to give you a link to click on, and you're already enrolled. So you don't have to do anything. If you want to come in on Monday, you're going to get the email, and you're all set to go. Not a problem. Sorry, everyone. Listen, thanks a lot for giving me your time. I really think this is going to be a very profitable endeavor. Now, somebody asked about the number of trades you get on a given day. If you look at 9 Forex pairs in the course of a trading session, you're guaranteed to get 4 or 5, if not more, really excellent trades. Now, listen, some days we may get a few, but that's the thing about the dashboard that is powerful. In a day where the markets are not trending, are the days where you're not going to get an alert and an alignment of a dot, are the days where you don't want to trade. They're the choppy days where the market, whittles away at your bank account. When you have a trending day and you get multiple entries, that's where you capitalize and you jump on the entries that come with an alert. So it keeps you out of the market when the market's choppy, and it brings you into the market on multiple signals during a trending day. And I've looked at, I don't know, many days, and on the euro dollar, the dollar yen, you can get multiple entries in the course of a session, and other days you get very few. But in looking at all 9 markets, you're going to get really, the problem is not going to be the number of trading entries, except on the rare day where there's just a very choppy market, and those are the days you want to stay away from anyway. So consider it actually a blessing when you don't get an alert and you don't get caught in a market. Because if you look at the market after it closes or after you're done trading, you're going to see that the market's just going to be filled with chop. And you're not going to have any good trends. You're not going to have any really superlative entries. And all the dashboard did was keep you off the mouse and away from trading a choppy market. That's all it is. So don't worry about the number of entries. Just worry about when you get an entry, it makes you money. And these entries do make you money. So listen, everyone, have a wonderful afternoon. We're going to send out a copy of the webinar. And we welcome everybody into the room on Monday. You're all signed up, and hopefully we'll see you all. And let's really make some money off the Forex, and see if we can pull down a lot of pips on a trending day and get a lot of good entries. Anytime there's an alert and a dot, we're in, and we're just going to hit the buy up or sell on a down close, and we're letting the ATM take care of the trade. All right, everyone, great afternoon. Thank you so much for coming, and hopefully we'll see everyone in the room on Monday. Take care.